Ladies and gentlemen, welcome to the Horizons main stage, Fiona Greig.
Good morning. Thank you for that warm welcome. It is so great to be here for this inaugural Horizons conference. I was inspired last night by John and his magic. I don't have magic for you this morning, but I do have data for you. My team has access to basically all of Vanguard's 50 million clients' data. These are people who have a brokerage account at Vanguard, or they're saving in a retirement plan that Vanguard administers. And being a data geek, I mean, this is something that I get up for in the morning. But what's really fun about it is we see all kinds of people. We see young people starting out their careers, saving for retirement. We see older people starting to retire, starting to withdraw. We see low-income families, we see high-income families. And quite humbly, we often see ourselves. We see ourselves in our own data. We see our parents. And this has been quite meaningful to me because it has me thinking a lot about my parents. In fact, I think a lot of us in this industry think about our parents, right? We are probably watching our parents age and retire, and at the same time, many of us are caring for kids, so we are sandwiched. This is a picture of my parents this past summer at a family celebration on a boat. In this picture, my dad is 78, my mom is 75. And if you were to ask my parents about their financial goals, they might share with you their top goal. Their top goal is that they don't want to be a financial burden on their kids. Now, thanks to a long career of saving and investing, and probably a lot of good luck, actually, sequence of returns, economic cycles that they had good fortune and timing with, they're going to meet that goal. And I don't take that for granted because, at Vanguard, we've done this big retirement outlook for baby boomer generations, and more than half of baby boomers are actually not ready for retirement. So I consider myself very, very lucky that my parents are. Now, if you were to spend a little bit more time with my parents at this party, let's say you spent some time with my dad, you might notice that he's wearing sneakers at this party. Very cool. What's even cooler is that not captured in this picture are the 2 hiking sticks he walks with at all times. So my dad doesn't have a lot of feeling in his feet. He struggles with balance, and he probably falls several times a year. So actually keeping Dad upright on this boat was our challenge as a family. Now, if you were to ask him a little bit more about his financial goals rather than his feet or his balance, he might share with you that he is supporting the family farm he grew up on. It's called the Greig Farm. It's a pick-your-own-fruit farm in upstate New York. Highly recommend, long way away from here. And farming is a tough business. Revenues, crops, weather can go up and down. And ever since my dad was 15 and found himself milking a cow, at 4 o'clock in the morning, he decided farming was not for him. But it is a place that is deeply embedded in his heart. And this is a farm that's been in the family for 80 years, and he wants to keep it in the family. So along the way, he has supported this farm and continues to do so. Now, if you were to spend some time with my mom, she looks amazing. She doesn't look a day older than 75. You would have found her on the dance floor at this party. She does not suffer from balance issues. And if you were to ask her about her financial goals, she might share with you that she is supporting her mother's retirement. So my grandmother is turning 102 this month. Thank you. And she lives in a nursing home, and my mom pays for that. So my mom, in her own retirement, is paying for her mother's retirement. So in some sense, my mom is the picture of longevity risk. And if you had a drink with my mom or built trust with my mom, you might hear that the in-law family farm is not her highest priority. This is a place she's been visiting for 50 years, sometimes begrudgingly. Yeah, the things that are probably most important for her in terms of any money that is left over would be charitable causes that she really cares deeply about, maybe even funding her grandchildren's education. Thank you, Mom. So I share this example not only because it's meaningful to me, but I want to wager a guess that it could be meaningful to you. My parents are in some ways a canary in the coal mine. They are the earliest of the baby boomer generation, and they quite literally represent the silver tsunami that is upon us. So in 2025, some 4.2 million people will turn 65. Jason Fichter calls this peak 65. Credit goes to him. There you are. Thank you. So never before have so many people turned 65, and not until 2050 will again this many people turn 65. Now, this isn't just an incredibly important demographic moment in our country. Wait for it. It is also an incredibly important financial moment. So the baby boomer generation has amassed some $82 trillion in wealth. To put that into perspective, that's more than double what the generation before had at its peak in today's dollars. Double. Now, a lot of that money, not all of it, right, is the opportunity. A lot of that will get spent down in healthcare, in supportive living arrangements, on cruises, family meals. But whatever's left, be that an asset or a liability, will start to move. This will be money that will start to move to the next in line. And it'll move disproportionately to women. So women, married women, have a 70% chance of outliving their husbands, and if they do, they will live potentially, or on average, 10 years. So for all of you who are serving your clients, if you were to serve my parents, you could expect to serve my mom for a decade or more longer than my dad. Now, this is the $82 trillion opportunity. It is also an $82 trillion risk, because some 70% of women change their financial advisors when their husband dies. When I first heard that statistic, I could not unhear it, so I'm going to repeat it again. Some 70% of women change their financial advisor when their husband dies. And I think this has incredibly important implications, not just for who we are serving, but how. So I want to translate this $82 trillion opportunity or risk into moments that matter, moments where you can deeply understand your client's financial identity, help them save over a lifetime and maintain that momentum, and stay invested. Those are my 3 things. Okay, so we asked our clients, roughly 6,000 of them, a very simple question. Do you consider yourself an investor? And we were surprised to discover that many don't. About 4 in 10 of our clients don't see themselves as investors, 3 in 10 men, and more than half of women don't see themselves as investors. So this was surprising because all of them are investors. They either have a brokerage account with Vanguard or they are saving in a 401k account. They have money invested in the stock market. They are all investors. So then we asked, okay, fine. You don't see yourself investor. How do you see yourself? When it comes to your financial decisions, what label do you most identify with? And we gave them a range of options. Most people see themselves as savers, men and women alike. That was the top label that most people connected with. Others were budgeters, investors, protectors, and I see my parents in this chart. My mom has been budgeting for her mother's retirement. My mom has been budgeting for her kids' college. My dad has been protecting the farm, right? So there are many different financial identities, but the one that was the most prominent was saving. That's good news, actually. Why? Because saving is the engine of meeting our financial goals, right? It is the driving force of any kind of investment plan. We need people to save. That is how they reach their goals. So this is just a picture of, how much of that goal would come from savings, or the principal in light green, versus the investment returns in dark green over, say, 10, 20, 30, 40 years. And at 10 years out, 80% of that goal is going to be reached by the original savings, 20% from the investment returns. It's not until you get out to about 30 years that the mix is 50-50. So savings is awesome. That is what we need people to do. But I say this because if you come at your client and the first thing you're talking about is what's going on in the markets, what's happening with equities and bonds, whether we should go long on international versus what's happening in the yield curve, blah, 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 and your clients are thinking about, am I saving? The conversation could go like this. You may not be tapping into the financial identity that your clients feel, the decisions they see themselves as making. They may realize the importance of investing and leave that to you. But in terms of the conversation, it's important to meet them where they are. Okay, next. Maintaining that savings momentum over the course of a lifetime. I've been having some of the most honest conversations with my parents I've ever had. A lot of them are about money. A lot of them are just about our lives, like what all the memories we shared. Gets me choked up. And one of the things I did recently was just, ask my parents about their careers. And I've lived this career, so I kind of know what Dad did all these years. But it was just striking to see it on a page. At a school, he worked 2 years, and then he joined a firm. He joined a company, and he worked there for 45 years. Only recently has he officially retired from them, but he still put up his shingle. And so now he's working for himself, and he'll probably continue to work until he dies. This man is a workaholic. He'll just keep going. And I used to judge him for that. I used to sort of say, come on, let's retire, but it's actually his source of, physical exercise. He walks to work. It's his source of community. It's his source of intellectual stimulation. So I now celebrate this incredibly long career that he has and continues to work. My mom had a very different career. She worked all the time that I was growing up, but she had different jobs over the long run, over the course of time, in part because we moved around from my dad's job. So every time we moved, my mom had to pick up and change her job. There are also times when she wasn't working. And after my brother was born when I was 11, she stopped working altogether. And what's interesting about this picture of my mom's career is that it's actually much more representative of the typical US worker. The typical US worker can expect to have roughly 9 jobs over the course of their lives. Those early jobs will be, short stints, 2-3 years. Then we have longer stretches in our 40s and 50s, and our final job, we might be there for 7-10 years. And the typical American will have a period of unemployment where they won't be working at all, either to care or because they're literally between jobs. And I'll tell you a story about this. About 10 years ago, I was switching jobs. And a friend of mine who's also a financial advisor, he was not my financial advisor, he was just a friend of mine, he said, Fiona, when you land at your next job, give me a call. I'd be happy to just spend half an hour with you, just helping you land on your feet. So I did. And I spoke with him, and he asked me just a couple of questions. It was a short conversation. He said, tell me about your income, tell me about your spending, and tell me about the workplace, the retirement plan in your new job. And he quickly concluded, he said, Fiona, this plan is auto-enrolling you at 3%, but I think you can save more than 3%. Why don't you sign up at 6%, and then also sign up for auto-escalation so that as, when you get little raises, like your savings rate will go up. This was the most generous and impactful piece of financial advice I've ever received. Why? Because it was a moment that mattered. I was switching jobs. I had 2 kids under 4. I was moving my family from Philly to DC. I was moving into a new sector. I was moving into a much bigger job that was kind of freaking me out. And although I had saved a lot more than 3% in my old jobs and considered myself a saver, like I was proud of that, that's a big part of my financial identity. The retirement plan and the details of that were the last thing on my mind. but it was the first thing on his mind. And so what's striking about this is that I could have gone with the default, right? That was the path of least resistance. But he made a huge difference for me in terms of a moment that mattered in my career, in my savings career. And it turns out, this is a moment I now see in the data. Turns out I'm not alone. So the typical American, as I said, can have 9 jobs over the course of their lives. So at Vanguard, we record keep many employer plans. We can actually watch people switch jobs. If we happen to record keep the old job, the employer plan there and here. So we assembled a sample where we can see people switching jobs, and we wanted to understand what's happening to their income and what's happening to their savings. Sure enough, their income is going up by about 10% when they switch jobs. Makes sense, right? Who would take a job if you're not getting a raise? All right, that's the good news. The bad news is that their savings rate is going down by almost a full percentage point. Now, this was literally me, right? This was going to be me. So we wanted to understand, well, what's going on here? You know, there's great choice architecture, there's plan design that's sort of supposed to help people save, right? Sure enough, those people who were joining companies where there was automatic enrollment, they saw a much smaller decline in their savings rate. Those people who were joining companies that didn't auto-enroll them, where they had to actively sign up for the plan, they saw a much bigger drop in their savings rate. 25% of these people were failing to sign up for the plan altogether. So some people were forgetting to enroll. Those people would have seen their savings rate go from, perhaps 6%, 7%, all the way to 0. But notice those going into the automatic enrollment plans are also declining. So we wanted to understand that and better understand, what is going on, and is the default savings rate in that plan playing a role? Sure enough, it is. So this is showing the percentage point change in the savings rate when people were switching jobs according to the default savings rate in their new job. And sure enough, people on the left who were moving to companies where they were being auto-enrolled, but they were being auto-enrolled at, say, 2% or 3%, they were seeing much bigger drops in their savings rate. In contrast, those who were moving to companies that were auto-enrolling them at 6 or 10%, they were seeing their savings rate steady or even increase. So plan design is playing a big role, and the conversations you are all having as people switch jobs can also play a big role. Just to put a fine point on this, imagine my dad, right? Remember, one big job for 45 years. If he literally did nothing and just went with plan design, auto-enrolled at 3%, auto increases up to 10%, plus a 3%, company match, his saving trajectory would look like this. That works. That's totally fine. But for somebody like my mom or me or the typical US worker, their savings rate could look like this. Each and every time they switch jobs, auto-escalate, boom, back down. Auto-escalate, boom, back down. With more frequency as you switch jobs more quickly, and then later on, you climb further, but you have further to fall. So imagine the role you can play the next time you hear your client saying, how's the family? Oh yeah, great, my son just switched job. Intervene. That's a moment that matters in that next in line's career savings. That's a moment that matters. Okay, now people don't save just in their employer plan, they also save in individual retirement accounts. And so we wanted to know just 2 things. Number one, when do people open these accounts? And over the course of 8 years, how consistently do they contribute? And we were surprised that people aren't opening these accounts until typically into their 30s, and they're not contributing in every year. And women tend to open them later, and out of 8 years, they contributed in 5 out of those 8 years, and men 6 out of those 8 years. So I mention this because, the typical US worker will have a period of time when they're not working. And that's an opportunity for when they can be, saving for retirement, continuing to save for retirement, even when they don't have a job, if the family can support it. And this is particularly important for people who are caregivers, right, who might take a time out of the workforce. If the family can sustain that savings rate, that saving for that individual, even when they're not in the workforce, that's a moment that matters. Lastly, staying invested. Now, one of the things that people do, I'm just going to go back to switching jobs. When they switch jobs, is they have their money in their employer plan, and they roll it into an IRA. Sometimes they're forced out of the plan, right, if they have a low balance, and forced out into the IRA. Well, we wanted to see what happens to the asset allocation when people switch out of the employer plan into the IRA, because we can see both sides of it for many people, right? We have these 50 million people. Some of them, we see both their 401k plan and their IRA. And we were surprised to see this. 28% of rollovers left that money in cash for 7 years or longer. This matters, you know, for a single rollover that happens before 55, this can mean $130,000 lower retirement savings at age 65, let's say for a worker starting out at 60,000. So that's like to the tune of 2 years worth of retirement income lost simply because they failed to invest the money in the IRA. Okay, now we wanted to understand who is most impacted by this. And sure enough, young people. More than half of investors under 30 leave their rollover money in the IRA sitting in cash for 7 years or longer. People with lower balances, women, are disproportionately falling prey to this sort of cash stickiness, this cash drag in the IRA. Now you might think, well, that's rollovers, right? Some rollovers are forced out. You know, that makes sense. You know, in the 401k plan, I was defaulted into a target date fund or some kind of balanced, you know, professionally managed allocation. It's an easy mistake to make, to think that in IRAs, I get the same. But we're also seeing this for contributions. So people making contributions to IRA. This is just 12 months. And many, many people, in fact, the cash drag for contributors is even higher than for rollovers. So that's another moment that matters, right? Oh, did you make your IRA contribution? Awesome, great job. Did you invest it? Now, you might think, well, is this really a really prevalent problem, Fiona? Like, honestly, is this a snafu in the data? Well, when you look at aggregate data, asset allocation across all of our investors by age, focus first on the brown line. This is the share of assets sitting in cash, depending on age, for people who are saving in a 401k account. This is the ideal, the brown line. This is what we want to see, right? Very low cash allocations for people who are young, who have long investment horizons. That cash allocation increases over time, tops out, you know, for the eldest. Then contrast that with IRA accounts. In aggregate, 25-year-olds have more in cash than 65-year-olds. Now, I mentioned at the top, you know, oftentimes we see ourselves in the data. The people who wrote this report had cash sitting in their IRA. So I challenge you, at the end of this talk, check out your IRA. See if you have any cash in it. You might. Okay, so one of the threats to staying invested is choice architecture. And the last thing I want to say about this chart is, you know, we all have our whys. We all have our reasons that why we love our job and what gets us up in the morning. This is one of mine, this chart, because at Vanguard, you know, our mission is to advocate on behalf of all investors, not just our own. We're investor-owned. And so one of the things we've been doing with this work is actually to advocate for policy change. You know, we have QDIAs, qualified default investment alternatives, in 401k plans. Lots of great choice architecture, right? We can auto-enroll people, we can auto-escalate, we can automatically invest them in target date funds, but we can't do the same in individual retirement accounts, right? When I put money into an IRA, it's sitting in cash. I have to make that second step. Why over here, in workplace plans, can we default people into a target date fund, but not in an individual retirement account? So we're actually advocating to Congress that we allow for that same kind of choice architecture in IRAs that we already have blessed in workplace retirement accounts. And you know, the ability to do that on behalf of all investors is something that is really meaningful to me. And actually, for Vanguard, we stand to lose from such a policy change on day one. Why? Because although we have very, very low expense ratios, we actually charge ever so slightly more on the money market than the target date fund. So if all of those assets were to move into target date funds, we would actually see lower revenues. Okay, so choice architecture is playing a really big role. Obviously, there are other motivators and other reasons why people aren't always invested. And some of them is the market volatility in the market itself. And this is very salient this week, right? S&P 500 is down over 4% over the last week. I think it's down another 0.8% today. Lots of worry, lots of fear in the marketplace. And this chart is showing, imagine you had put $10,000 in the market in 1992 in just a broad range, index fund of some sort. And imagine you experienced fear during the tech bubble, or during the global financial crisis, or during COVID-19, and you had pulled that money out and put it in cash. The yellow lines represent what that would be worth today. So starting with 10,000, if you had pulled that money out during the GFC, you would only have 25,000 today. Now this chart only goes through October of 2022, so there are a couple more years of steep inclines after that, but instead, that money could have been worth over 160,000 and more even today. So if your phones are ringing off the hook, give them comfort. Ask them, I know the markets are volatile today, but has your goal changed? Has your investment horizon changed? Has your timeline changed? No? So then why should your asset allocation change today? But that fear is real, and people are almost invited to experience that fear. If we look back on August 5th, 2024, headlines today sound a lot like these, right? In fact, the editors and ChatGPTs are probably literally recycling headlines from this day, when on August 5th, when S&P 500 fell 3% in one day. Probably remember this day last summer. Probably ruined some of your summer vacations. Reasons to panic. The global stock market plunges. Why the stock market is freaking out again. Maybe you should too. Well, here we actually have some good news, because we looked at how many people actually traded on August 5th, 2024, and just 2.5% did. 97.5% stayed the course, did nothing, tuned out this noise. And those that did trade, well, most of them bought the dip. 73% bought equities rather than sold. So I talk about this volatility not just because it's really important today and in our current times, but because it's an example of the ways in which financial advice provides not just financial planning and portfolio value, but also emotional value and time savings. So on a week like this, if I'm managing my own assets, I'm reading the news, I'm opening up my portfolio, I'm seeing how far mine has plunged, I'm wondering what I should do. I'm probably doing this during the workday, right? Shirking from my job to manage my own finances and worry about them. But I also talk about this because back to that sort of financial identity that people experience, if you're not connecting with your clients at an emotional level with the words that they use to describe their financial decisions, you might be missing out on some of that emotional value that you could be providing. Now, we recently asked a big sample of our clients, over almost 8,000 clients, to quantify, compared to managing your finances on your own, does advice increase your peace of mind? Does it save you time? And we wanted to understand this differently for people who are in just digital advice versus those who have hybrid or human advice. Across the board, the vast majority of people are talking about the greater peace of mind and the time savings that they see. But notice the human advice numbers are much higher, right? 88% of people with a human advisor say it gives them more peace of mind, compared to 69% for just digital. And they're also saying that it's saving them time. 78% are saying that it saved their time. So although they're spending time with you, it's actually saving them 2 hours per week. Time when they're not busily checking their balances or worrying about the press or trying to actually understand what's going on in the markets or formulate their next move. So this is just an example of the kind of emotional and time value that you are delivering to your clients. So pat yourself on the back. So as you think about your clients, I want you to show up for those moments that matter. And this $82 trillion opportunity is a colossal aggregate moment for our country that translates into or manifests itself into kind of a daily reality for your clients. So at the start of the job, if you hear that your client's son is starting a new job, call him up and say, hey, have you enrolled in your plan? Are you maintaining your savings rate from your last job? Are you maximizing the employer match? Imagine you've heard your client, his wife is leaving her employer. Keep saving. Contribute to that IRA. You can do that even while you're not working. Consolidate your assets. Let's figure out where's the right place to do that. And stay invested. So as you think about this, the $82 trillion opportunity is starting now. And I want you to think about who is next in line. What are her financial goals and roles? Can you help her achieve them? Because when you engage a client, you are helping a whole family. And you can do that by engaging men and women uniquely on their specific financial roles, goals, and time horizons. You can help them maintain their savings momentum over the course of their lives, not just in one job. And you can help them stay the course in balanced, low-cost investments. Thank you.